Good evening, everyone. Welcome to our Long Beach State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. I want to thank you guys for taking time out of your busy schedules on a Wednesday night to join us for tonight's class. Tonight's class runtime will just be about an hour. We try to make these classes very interactive. So as we go through tonight's class, really encourage you to ask questions of us. We'll be kind of monitoring what you put in the chat function as well as Q&A within Zoom. And then my colleague and I, Ken, will be answering those questions as we get a chance to as we roll through the content. And so the design of this home buying class is just to help educate you on what it could look like for you on the next steps on your path in homeownership. And like I said, this is a very interactive session. So as we go through tonight's content, really encourage you to ask questions. We want to hopefully get a lot of good takeaways for you tonight. My name is Jason Maida. I'm going to be your presenter tonight. And we get a chance to teach these classes about 4 times a year for Long Beach State alumni in athletics. And what we found in teaching these classes over the course of the year just allows you to have more tools and resources to help you on that path towards homeownership. I'm with an organization called American Pacific Mortgage. We're the 10th largest lender in the country, and we're based out of California, but we are a nationwide lender. So I think most of our class is here in California, but if you're looking in other parts of the states, we can certainly support you with homebuyer resources there as well. These classes are really kind of designed more to help support first-time homebuyers. So a lot of the content we cover tonight will be centered around that. Tonight, we're going to talk a little bit about the housing market, what's going on there. We'll talk a little bit about interest rates, which usually is a pretty big topic, especially this time of year. We're going to spend some time looking at a budgeting analysis. We're going to compare renting versus buying and what that could look like for you. We'll also give you some resources around credit, how to improve credit, how to learn a little bit more about credit. We'll also spend some time looking at student loans and how those can impact qualifying, documentation usually needed in the home buying process, as well as first-time buyer programs that can be a resource to help support you with down payment and closing costs. And then we're going to kind of walk you through the buying process. So after tonight's class, you may say, hey, Jason, I want to learn a little bit more about a home buying plan and how I can kind of get myself aligned for homeownership in the future. We'll kind of share with you kind of the next steps of what that would look like for you. All right. So thank you so much again for joining us tonight. And let's kind of dive in. And I think we got to first kind of talk a little bit about buying and does it really make sense for us? So after tonight's class, you may figure out maybe this is something that could work for me. Maybe it may not, but I think it's important to consider the benefits of home buying. And here's what we see typically is, first of all, it's going to create stability in your housing budget. So you don't have to worry about, let's say, your rent going up when you decide to renew your lease, because now you'll have a little bit more control with knowing exactly what your mortgage payment's going to be. As your home appreciates over time, so as the home goes up in value, as you pay down your mortgage balance, the difference in those two figures creates home equity. And home equity can be, an opportunity to transform into generational wealth for you. So when we think about wealth in general, that's probably one of the number one things for most people is just having that equity within their home. And there can still be some really good tax benefits that come along with owning a home. So as we coach first-time buyers thinking about their budget for first-time home buying, it's not necessarily an apples-to-apples comparison. And to illustrate that point, I thought it would be helpful for us to dive into a budgeting exercise, kind of as our first step in tonight's class. So let me do a quick switch up or transition in our screen share. Let's kind of talk a little bit about this budgeting calculator. And this is going to be a rent versus buying analysis, looking at what it could look like if I want to continue to rent versus what could it look like if I decide to purchase a home in the future, right? And so we're going to kind of walk through this calculator. Just as a quick side note, tonight's class is being recorded, so we'll have the recording of tonight's class up on our YouTube channel. I know we had a lot of people signed up for tonight's class, so those of you who are joining late or maybe you just couldn't stay for the whole class, this will be up on our YouTube channel tomorrow, so you can check it out as well too. We'll also share back with you all of the presentation material from tonight. So if you want to do a look back or reference some notes, you can have the presentation. So, all right. And included in the presentation material will be this rent versus buying calculator. So we kind of pre-filled some of the screens here or the data fields just so we can kind of help you understand a little bit. But what this kind of shows us is that comparison of renting versus buying. So if we first of all look at our rent section, we have a projected rent of $27.50. We also assume that our renter's insurance is going to be about $15 per month. And then we expect rent to go up about 5% on an annualized basis. Okay, so that's on the rental side of the equation. Now, from a home purchase perspective, obviously it depends on where we're going to buy, let's say in California, but let's assume a sales price of $750,000. The minimum down payment to purchase at that level is right around 3 to 5%. So we're going to plug in 5% for tonight's exercise. We assume property taxes for our home. We also have the homeowner's insurance for our property, as well as unexpected or expected maintenance cost for my home. Okay, so that's in the kind of the home side of the comparison. And then we want to look at what type of financing am I going to get. So if we look at typical loan stuff, we have expected interest rate. Now we have it at 6%. Maybe you could argue that's a little bit higher right now. We have origination charges for the financing. Now, one of your added benefits as part of the Long Beach State alumni is we actually discount our closing costs services to clients. So we actually have a $750 discount program. You're going to learn a little bit more about that in tonight's class. And then the next section is discount points, and that allows you as a buyer to pay additional costs out of pocket to bring down your interest rate. So that's called a discount point. Usually one discount point is the equivalent of 1% of my loan amount, and that 1% will translate into about a 0.25% reduction in mortgage interest rate. Now, all that being said, I don't necessarily recommend clients paying those out-of-pocket expenses because the break-even point is usually about 3 to 4 years when we think about discount points, especially in today's kind of transitional market with interest rates where we're starting to see interest rates decrease. Those that are buying right now, it doesn't necessarily make a lot of sense to pay points right now. And then there's other settlement service charges. Those are things like title, escrow fees, maybe some of the transfer taxes involved with whatever county I'm going to buy in. So those are going to be tied together with what we call is closing cost to purchase a home. In general, closing costs will be about 2 to 3% of your purchase price, depending on ultimately what you negotiate with a seller, but that's kind of a general range that we would want to think about in home buying. So usually when we kind of factor in savings for home ownership, we want to look at down payment as well as closing costs and prepaid items, which we're going to talk a little bit later in tonight's class. And then the last assumption we're going to look at is how much will my home appreciate over time? So we have 4% in our projection here. We look at how long am I going to be in my home versus renting. We look at the selling costs of my home, let's say at the end of 7 years. And then we're going to factor in state and federal tax rates and compare that to a savings rate. So to go back to kind of the comparison, like this isn't an apples to apples look at things. So when we look at homeownership, there's clearly benefits that go into owning that you don't realize on the rental side. Now, there's a trade-off, right, from a payment perspective, because, if I'm really comfortable renting at $2,700 a month, from a mortgage perspective, I would elevate to $5,700 a month if I'm going to buy a $750,000 house. That's obviously quite a leap forward. At the same time, the total cost opportunity over 7 years is about $68,000 to the buy side versus renting when we factor in the benefits like home appreciation over the next 7 years, as well as tax benefits that come along with owning a home. So again, that kind of just illustrates for you that it's not really kind of a fair comparison looking at renting versus buying. It's important now to design a budget that's going to fit for you in your home ownership plan. But ultimately, there's a pretty big opportunity in the market from a home ownership perspective. Now, if you're going to buy at the $500,000 level, then that mortgage payment will be a lot less. And then the opportunity is even greater for you because you have a lower monthly budget. All right. So I would encourage you, if you have some time, take an opportunity to go and kind of dive in that calculator. I think it'll be a useful exercise for you to kind of better understand about what homeownership can look like for you. All right, so let's talk a little bit about the housing market. I think that's a kind of top of mind for most of our clients that we consult with across the country. And, we're looking at the housing market really carefully right now. The market looks very similar in most parts of the country. Now, the median sales price might look a little bit different, but when we take a look at LA County, which we've kind of spotlighted for tonight's class, I know a lot of you are maybe in LA or Orange County, or maybe in Riverside or San Bernardino, maybe in Northern California, but those markets have different price points, but the trends in the market don't look that much different. If I was to kind of look at 2024's housing market in general, and historically what we see is in the spring buying months, which would be April and May, we usually start to see a big uptick in buyer demand and active listings that are coming online. It's interesting, in this year in 2024, we really haven't seen buyer activity pick up until around July or August. And I think a lot of that is heavily driven on what's going on with interest rates, because I think the average consumer is just wondering on what's going on with interest rates. And I think most have settled on the fact that rates are probably not going to move too much. So I want to get into the housing market. And so you are seeing buyer demand pick up there. At the same time, inventory levels really haven't changed in most parts of the country. So kind of what you're seeing right now, and this is kind of looking at, probably more of an August look at things, but prices have dipped a bit in LA County. So you're seeing some homes that maybe were kind of sitting on the market a little bit. Those homes, if they're not in bad condition and they're viable properties to purchase, now we're seeing buyers starting to kind of grab onto those properties. But the market's kind of seasonally kind of gone down like this, but we're starting to see the market kind of level a little bit because that buyer demand is picking up. Now, I think the question on the go forward basis is, what does inventory levels look like in the housing market? Because ultimately, as interest rates decrease, which we're going to talk about now, interest rates will start to drive down. But if buyer demand picks up, there's not necessarily a lot of inventory to support buyers right now. And so you see a lot of builders trying to kind of fill in the gap right now. But in some areas like the greater metropolitan LA area, like there's not enough land, right, for building. So that's why you see a lot of builders building out further east in the San Bernardino, Riverside County. Obviously, those price points are a lot cheaper, but the inventory is kind of the challenge right now in the market. So we are seeing some really good trends in interest rates, although, in the last 2 or 3 days, interest rates have kind of bubbled up. I want to kind of give you guys kind of just some perspective on the market right now and kind of why we're here from an interest rate perspective. And before we go there, let's kind of talk a little bit about the last 12 months of interest rates, because as we go back to even October of 2023, rates hit 8%, was the highest level we've seen in the last 20 years. Now, interest rates have kind of bumped along here, and the 30-year fixed mortgage is represented by this blue line here. But rates dipped back down to below 7%. They kind of bumped around a little bit, and you've seen this kind of steady decline. Well, interest rates were at elevated levels and still remain there based upon what the Federal Reserve has been doing to try to combat inflation. The inflation goal for the Federal Reserve is 2%. We're still above that. We're like at 2.6%. But the Federal Reserve is now in a position where inflation is getting a little bit more under control. And so now you're starting to see the Federal Reserve kind of pull back on interest rates. And so 3 weeks ago, the Federal Reserve announced a 0.5% cut in rates. So that made kind of the headlines on the news. And I think for most consumers, we assume that everything will drop in interest rates, including mortgages, which just isn't the case necessarily. So mortgage rates have already kind of fallen ahead of that with just speculation on what the Federal Reserve would do. But when the Federal Reserve cuts interest rates, you'll see a drop in credit card rates, auto financing, some personal loans, some of that stuff will start to drop as well. Now, as we move forward and it's kind of a fluid situation, we're really watching what the Federal Reserve is doing. They have another meeting next month, and the projection right now is that the Federal Reserve will cut rates another 0.25%. It's about an 86% projection on that. That will also lend to a lower interest rate environment. But the concern right now that we're watching really carefully is the strength of the labor markets, because last Friday, the labor markets showed a much stronger result than we expected, and it actually put mortgage interest rates up a little bit. So we've seen the average mortgage interest rate tick up about 0.25%. So we're going to be watching tomorrow, not to get too far into it, but we're going to be watching tomorrow because there's another inflation reading coming out in the economy. And so how that reading comes out will obviously influence probably what the Federal Reserve is going to do next month and give us a little more clarity on what interest rates look like for the remaining part of 2024. Now, one of the questions we get often is, how will interest rates be influenced by the pending election, right? Well, Federal Reserve monetary policy is already in place, so the election shouldn't swing interest rates one way or the other. But the Federal Reserve has kind of their projections on what, and we have kind of a projection on what we think the Federal Reserve is going to do. So potentially 1 to 2 more rate cuts this year and a projected 4 rate cuts in 2025. So I think the trend for interest rates is going down. The question is more of when do interest rates actually go down? Now, when we think about interest rates on the mortgage side, it's not a one size fits all. So credit eligibility plays a role. The type of product I have will play a role. How much I finance, what my down payment is. We talked a little bit earlier, in case you missed it, we talked about discount points where I can pay additional costs out of pocket to bring down my interest rate. But that doesn't necessarily make a lot of sense because for those of you that heard it earlier, it's about a 3 to 4 year break even when I invest those type of costs. So we want to be really cautious in that. And if I shorten my term of my loan, so the standard term of a loan is 30-year fixed mortgage, but if I shrink that down to maybe 20 years or 15 years, my payment will elevate, but generally that brings together a lower interest rate offering. Now, as we meet with clients to design their home buying plans, we're going to figure out what the right product match is for you. And that's kind of one of our services we provide in designing home buying plans for clients. All right. Before we get into the credit section of tonight's class, any questions so far? I know I've kind of given you a lot of material so far. I just want to make sure that I'm not going too fast and missing anything from you guys. Again, any questions you do have, you can use the chat feature or Q&A, and we'll do our best to get those answered on air. All right. Well, let's talk a little bit about credit. And when I think about home ownership for our first-time buyers, there's usually two challenges to home ownership. It could be around savings because I just haven't, basically saved enough money to make my purchase. And we're going to talk about, potential solutions there. But it could be around credit. And on the credit side, it's just because I don't know what my credit score is, or maybe I'm a little overextended in credit, or maybe I have potential historical issues on my credit. So we like to kind of dive into that as part of our class to give a little bit more insight as to how credit can be, kind of in the best possible position for home financing. And there are 3 different models to credit scoring. There's the credit card model, which you're gonna see that show up in most of your credit monitoring services. There's auto credit score, and then of course there's the mortgage score. So I thought we could spend some time looking at the FICO score weighting for the mortgage score, considering that's what we're talking about is home financing. So if we look at that, 15% is going to be how long have I had credit. So the more mature my credit file is, potentially the higher my credit score is going to be. 20% is going to be how much new credit am I trying to access? Am I opening new accounts? Do I have new inquiries on my credit? All of that stuff will impact the 20% weighting. Now, in our process to design home buying plans for clients, we only start with a soft credit score. And the reason why we do that is because, most of the first-time buyers that we work with, there's a longer kind of timeline for buying. It might not be a this year goal. It could be a 2 or 3 year goal. And so a soft credit check only gives us visibility to the credit score, doesn't put an impact on the score. And 30% is going to be credit utilization. So we're specifically looking at revolving accounts, and a utilization looks at a percentage of balances versus credit limits. Ideally, if you're trying to optimize your credit score, you want that utilization to be at 10% or less. Now, if you've kind of acquired some debt because of, whatever the expenses might be, and maybe you're running a 70% or maybe 80% utilization, I would encourage you to try to whittle that debt down to 50%, and then you should see some improvement in your score. And then to optimize the credit card utilization is to get down to 10% or less. Now, one of your, or one of our tips, I should say, for tonight in kind of managing credit card debt is to kind of look at the dates on which your credit card issuer has set up for your billing cycle date as well as your due date. So the billing cycle date is when the credit card issuer closes out all the activity on your credit card, and the due date, of course, is when your credit card is due. So here's my tip for our class tonight. If you can get in the habit of paying down your credit card before the end of the billing cycle date versus paying it on the due date, what happens is you actually catch the credit card before the issuer sends out the data to the 3 agencies. And by doing so, you bring down your credit score, give yourself a lower utilization level, and hopefully improve your credit score. Because on the billing cycle date, the credit card company is going to send out all your payment information to the agencies. And those agencies are Equifax, TransUnion, and Experian. So if you can get that balance paid down quicker or before the the billing cycle date hits, then like I said, you'll have that improved credit score. And then the last component to the credit scoring is payment history. So that's looking at how have I paid my bills. And as you're looking at your historicals on your credit report, if you've had any late payments, those are rated as 30-day lates, 60-day lates, and then 90+ days delinquency. So the more severe I'm on that spectrum of late payments, or the longer my late is, the bigger impact I'm going to have to my credit score. Specifically in the most recent 12 to 24 months, that's going to be the most impactful to my score. Now, if I had a late payment in October of 23, as I get further away from that late payment, the more improved my credit score is going to be. Now, again, there's 3 different agencies for credit scoring: TransUnion, Experian, and Equifax. They all have different risk assessments to them. So that's why your scores are going to look a little bit different. between all three agencies. Now, every loan program has a different minimum credit score. You can see those on screen. So most products, the minimum credit score is going to be at least a 580 credit score. Now, bigger events like bankruptcies, short sales, maybe a foreclosure, they will stay on your credit report for at least 7 years. They're bigger events, so they're going to have a bigger lasting effect on the credit score. But again, as I mentioned earlier, the most recent 12 to 24 months from the event will have the biggest impact to the score. Now, if you're in the habit of doing balance transfers or opening up a new credit card and then closing out the relationship with the old credit card company, I would just be careful on closing out credit cards, especially long-standing accounts that are over multiple years, because when you close out a revolving credit card, you actually take away all the history out of the credit bureaus because that relationship is no longer active on the credit report. It also can hurt you from a utilization perspective because if you lose, let's say, a $10,000 credit limit in your aggregate totals for credit utilization, then that will lift your utilization and potentially lower your score. So just be careful before you start closing out accounts. We've seen some clients in the past that maybe had 3 credit cards active, and then just to not have the temptation of a credit card, they closed out 2 of the 3, and we've seen those credit scores come down because of that. Now, in financing, we do look at all 3 credit scores, but we only take the middle credit score of all 3 scores. So if my highest score is 760, let's say my middle score is 740, and then my lowest score is 720, well, we're going to take the 740 credit score from a qualifying perspective. And that's important to understand because that can impact your product offering, your interest rate, even mortgage insurance if you put down less than 20%. Now, that's if I'm applying individually. But let's say I have a partner that wants to join me on my application, but my partner scores are 720, 700, and 680. Well, we look at the lowest middle score between both borrowers. So in this case, my partner has a 700 score. So with that lower score, I could potentially have a much higher interest rate or maybe higher mortgage insurance premium, or maybe my product offering might change a little bit. So those are things that we kind of talk through with clients just to make sure that we have financing in the best possible position. Now, if you've had some past kind of legacy items on the credit report, like maybe there's a late payment from back in the days, or maybe a inquiry that you're waiting for it to fall off, this is how long they'll remain on your credit. So this is kind of a matrix to guide you there. Now, the lasting impact for maybe in a hard inquiry will be in the most recent 6 to 12 months, or maybe a late payment 12 to 24 months. But as you get further away from those events, like I said, you'll start to see some improvement in the credit score. Now, student loans come up in our conversations with clients. It's just the reality of our environment. But I think, it's important to understand that those aren't necessarily hurdles that we can't overcome in home financing. Now, I do understand there's also forgiveness of student loan debt, which is awesome. At the same time, if you don't have forgiveness of debt and you do have outstanding balances, we do have to factor in monthly payments for eligibility for home mortgage financing. Now, if you're in forbearance, or let's say you're in deferment because you're back in school, there still is a minimum payment that's going to be counted into the qualifying, even if you're not making monthly payments on those student loans. Now, the ideal situation is, other than forgiveness of debt, is to have an income-based repayment amount, because generally those are going to be the lower payments because those are based upon your most recent filed tax returns, and that's how they kind of calculate that expense. Now, if you have, let's say, $75,000 in student loan debt and you're in forbearance or deferment, then by default on a conventional loan, we count 1% of the balances. So that would be like 750, right? Now on an FHA loan, which is a federally insured loan, the default is 0.5% or $375. But let's say I'm on an income-based repayment amount and that income-based repayment amount is 250. Well, that's all that I'm going to count for the qualifying. All right. So, that's an important topic because it does come up quite a bit in my conversations with our first-time buyers. But I think it's important to understand that, even though you may have a certain level of balances with student loans, it's still something we can work through in designing a home buying plan for you. All right, so let's talk a little bit about loan programs. And, what we do in these classes is kind of give you a high-level look at guidelines for programs and just give you some of kind of the features and benefits of these, because you may have heard of some of these programs, but we can kind of tie it all together for you. So we're going to spotlight 5 loan programs for you in tonight's class and give you kind of a little bit of the features and benefits of each. And the first one we'll kind of talk a little bit about is a Fannie Mae or Freddie Mac conventional loan. So you may have heard that terminology before. Fannie Mae and Freddie Mac especially was, front and center when it came to the housing crisis back in 2008. But Fannie Mae and Freddie Mac are an agency that basically handles about 60 to 70% of all mortgage originations across the country. So, we have guidelines that we underwrite to for Fannie Mae and Freddie Mac. Those products for a first-time buyer require a minimum of 3% down to purchase a home, up to a loan amount of $802,650. And that's what we call the conforming loan limit. That loan limit gets updated every year right around this time and gets instituted generally right away for most lenders. It is based upon cost of living changes. And of course, obviously cost of living has changed for all of us, but that limit has risen from 765 to 802,650. Now, there's also high cost of living areas in markets like, LA or Orange County or San Diego or even in Northern California, where we can stretch that loan amount up to $1.149 million. However, it does elevate the minimum down payment from 3% to 5%. On a conventional loan, it does have a minimum credit score of 620. And with a conventional loan, most times we're looking at really clean credit history for at least the last 24 to 36 months. The conventional loan, when we do put less than 20% down, carries with it mortgage insurance, or PMI, private mortgage insurance. We have a segment on mortgage insurance. We're going to kind of cross compare conventional loans versus FHA loans. We'll talk about that in just a minute. On the FHA loan side of things, that is a government insured loan. FHA stands for the Federal Housing Administration. That's not just a first-time buyer program. It's offered to any new buyers or second and third time buyers or beyond. It has a minimum down payment of 3.5% up to a loan amount of 1,149. So that's for the high cost of living areas. So that number can actually change a little bit based upon county, but ultimately it's a 3.5% down payment. Now, you're going to learn more about the mortgage insurance when it comes to FHA loans, but it is a government insured loan, so there's a lot more flexibility in the guidelines. We go down to a 580 credit score. If I've had some late payments in the past, FHA would be they would be okay with it, versus a conventional loan might be a little bit more restrictive. And then the next product is our VA home loan. So that's for our veterans that have served and have VA eligibility. The veterans product has a lot more flexibility to help support the veteran in home ownership. It's a zero down payment option, up to $1 million plus in loan amount. If the veteran has any partial disability from the VA, what we call a VA funding fee is completely waived for the veteran. So, and when it comes to past maybe legacy credit challenges or maybe higher expenses, the VA product has a lot more flexibility in that regard too. Then the last two products, one is the USDA product that allows someone to purchase in more of a rural area. So if you wanted to purchase maybe in Joshua Tree, for example, and you fit the criteria of USDA, you can get 100% financing in that market. It is a guaranteed loan by the United States Department of Agriculture. There's two kind of big qualifiers. It's about location with that product, but it's also about household income. And there's some formulas that we kind of take clients through who have interest in that product. And then finally, the jumbo loan is a product for clients that need a little bit more financing support, that have to finance above loan amounts that typically Fannie Mae or Freddie Mac can handle. That has elevated credit score requirements. Usually it's about a 680 minimum credit score. Right now in today's market, just given the interest rate climate, jumbo loans tend to be a little bit more elevated interest rate than what we'll see on conventional loans. Now, there are some additional asset requirements with jumbo loans. Usually in traditional financing, we have to save up for our down payment and closing costs, but there's additional what we call as reserve requirements with a jumbo loan that makes us set aside at least 12 months of my monthly mortgage payment. So if I have an $8,000 mortgage payment, I would probably need about $96,000 in additional assets. Not typical for most first-time buyers, but certainly like to kind of put a little bit of spotlight on the jumbo product in case that's a resource you need access to. Now, let's talk a little bit about mortgage insurance. And I kind of highlighted this earlier. Mortgage insurance comes into play on a conventional loan when we put less than 20% down to purchase a home. Now, that is called PMI, or private mortgage insurance. There's also another form of mortgage insurance, which is on an FHA loan, that is a government insured product. Now, PMI or mortgage insurance does the same thing. It ultimately insures the lender against default by the buyer. All right. So let's kind of look at conventional mortgage insurance, or PMI, private mortgage insurance. There's about 7 or 8 different mortgage companies that we partner with on PMI. There's different options in how you pay it. You can pay it monthly. You can split some up monthly, some of it up front. You can pay all of it up front. You can actually even elevate your interest rate to completely buy out your mortgage insurance. The most common option is monthly mortgage insurance because it does have a cancellation option that once I reach 2 years in my home and then I have at least 22% equity, I can apply to have the mortgage insurance canceled. Now, specific to PMI on conventional loans, the premium is going to be based upon what my credit score is, how much I decide to finance, and then ultimately what my down payment is. Now, if some of you in tonight's class have actually started searching on Redfin or Zillow, maybe kind of tooled around with some of their calculators, what you'll find is that a lot of their calculators used aren't going to have accurate examples of PMI because they're not calibrated to some of these characteristics like the down payment, the credit score, and the amount financed. Now, if we were to look at our own example of what a calculation looks like for a conventional loan, you can see down here, let's say we finance $700,000, we put down 3%, and we have a 740 credit score. Well, the mortgage insurance is manageable. It's at 209. And so when you compare that to some of your searches, it might look a little bit different. Now, if I can elevate that down payment, or let's say my credit score moves to a 780 or 800, then that mortgage insurance will start to decrease. On the FHA side of things, it's a little bit more universal. FHA is a government insured product. Now, whether I put 10% down or I put 20% down, there still is FHA mortgage insurance. And there's actually 2 forms of mortgage insurance. There's upfront mortgage insurance, which is 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my total loan amount. Then we divide that 12 to pay for it on a monthly basis. Now, with FHA mortgage insurance, it does not have a cancellation option. So typically, we're going to use the FHA loan as a bridge to get into homeownership and then eventually try to refinance into a conventional product. The FHA loan is going to have a lot more flexibility in qualifying. That's because it has that government insurance component to it. Now, on the FHA calculation for mortgage insurance, if we took that same loan amount of $700,000, now I have to kind of include into the calculation my upfront mortgage insurance, which is about $12,000 because it is that 1.75% of my loan amount. And then the monthly side is about $320 a month. So the expense structure on the FHA loan is obviously more significant than the conventional loan. But I think it's important to understand in our class is that not every client will qualify for a conventional loan. So that's why that consultation is really important, because we're going to start designing options based upon what is the right product match for you to help you achieve your goals of home ownership. And I think FHA can be a great, like I said, bridge to home ownership, and then long-term looking at conventional options too. All right, so the next thing we want to talk a little bit about is income and documentation for home ownership. And so we're going to kind of go through some scenarios around employment, but I just want to provide you with a quick little checklist on helpful documents that you would eventually need to get together whenever you decide to start that journey. So usually it's the last 2 years of W-2s, most recent 30 to 60 days of pay stubs, depending on your pay cycle. And then if you're self-employed, we'll generally want to see the last 2 years of tax returns. You do have to be self-employed for at least 2 consecutive years of tax filings. Now, as it relates to income, we have to verify at least 2 years of employment and or educational history. So I may be new on the job. Maybe like I talked to a client earlier this morning, she's been on the job 1 month, but we're able to show a past track record of history of employment as well as education. That would fulfill a 2-year requirement. In some cases, we have clients that are in transition of jobs and they're going to start a new job in November, but they want to qualify for home financing. We can actually use an offer letter to qualify them for the financing based upon projected earnings. The big thing we have to kind of really figure out is a 2-year history of either employment or education. So in a lot of our classes that we teach through our university partnerships is looking at an example of, let's say, someone that just graduated in spring of 2024, right? And is just entering the workforce. Well, if I have 4 years of undergrad at Long Beach State and I just went in and I got hired on an accounting firm, if I studied in accounting at Long Beach State, I've now met that 2-year requirement because I have my undergrad, and of course I've started a job that allows me to generate an income on a monthly basis. So those are kind of scenarios we look at. Now, where the 2-year rule gets a little bit different is especially for dual employment. So we see this sometime in fields like the healthcare industry where maybe some clients are working at multiple clinics. In that case, I do have to show that I can demonstrate working on both jobs simultaneously for 2 years at the same time. I mentioned earlier about self-employed clients. We have to show 2 years of tax filing. That also holds true with clients that are maybe doing side work as Uber or Lyft driving. I have to show that I have a 40-hour work week job or a full-time job that I've been working consistently for 2 years at the same time while I'm doing my side work for 2 years. So those are some of the things that kind of come up is in consultations with clients. Another important thing to keep in mind is additional sources of income. Like if I have a partner that's going to contribute to our household expenses, or I have, let's say, room rents that I'm currently realizing as a renter, generally those sources are not going to be allowed into the qualifying equation. Now, if my partner wants to include themselves on the application, then we can use the income. But if they're not going to join the application, then that income would not be counted. All right. So when we think about income in the finance world, we also got to compare that to what expenses look like. And that's called a debt to income ratio analysis. And we're looking at your pre-tax income in qualifying versus what your expenses look like. Those expenses include your new mortgage payment, taxes, insurance, and we're going to talk about what that exactly looks like. We're also going to consider personal loans, car loans, student loans, credit card debt. All that gets factored in. Generally, we don't want those expenses to exceed more than 43 to 45% of your total income. So that's generally how we kind of view that. Now it is looking at pre-tax income for those of you that are W-2 wage earners. And this is kind of what the calculation looks like. We're going to take into consideration the principal and interest of my new mortgage, what my property taxes look like, what my homeowner's insurance costs are going to be. And if I put less than, say, 20% down for maybe a conventional loan, we have the private mortgage insurance. And then we take a look at our other debt. So in this example, we have a client that has $4,000 in outgoing expenses, and they're making $11,000 in pre-tax income. So that debt to income ratio is at 36.4%. So that metric would be used for qualifying in home financing. Again, generally, we don't want that to be more than 43 to 45%. On exception, we can go up to 50%. Now, this is just a metric for qualifying. It doesn't indicate affordability. That's a conversation that you and I are having as we're building your plan. There's two big goals for us in homeownership for our first-time home buyers. One is it sustainable over time, right? So there might be challenges financially down the road. And is it affordable for me? And so those are conversations we're having. Of course, we want to make sure you can qualify okay, but we have to figure out what the right number is for you from a budgetary perspective. Now, one of the questions I get on this calculation from most of our home buyers I work with is, well, Jason, what's kind of the comfort zone or what's the sweet spot, so to speak, right, from a debt to income ratio? It varies for every household, but I would say in working with thousands of first-time buyers across the country, it usually is about 33 to 36% is kind of what I found is kind of a good go zone, so to speak. So like this would be an example of someone's kind of right there. But everybody has kind of a different tolerance level when it comes to debt to income ratio. But again, affordability is kind of really the big key component there. Okay, the last topic we want to talk about before we dive into the workflow of buying a house is just savings and savings around down payment and closing costs. Those are kind of going to be your big items for saving for home ownership. You know, savings is that second challenge that we have with first-time buyers. So we're going to talk about a savings plan in just a bit, as well as some first-time buyer assistance programs available to you in the state of California. I want to provide you with kind of what you should generally think about documenting in terms of savings. So usually it's checking in savings account statements for the last 60 days. Cash accounts cannot be used. So if you have cash deposits, those aren't paper trail able. So we have to kind of document that accordingly. You can at times use 401ks, 403bs, even IRAs. Those are allowed in financing. I always just encourage our classes, talk to your financial or tax advisor before you access those assets. And then family members can also contribute towards your home purchase. We call that gift funds. There's a procedure for documenting those funds, but those funds do not need to be seasoned. Usually most assets have to be seasoned 60 days, but not in the case of gift funds. Now, savings is kind of where there's obviously an area of opportunity for us in home ownership. And so I want to give you a kind of a savings plan action item. And it kind of goes like this. It's a really simple approach, but let's say today I'm paying $2,500 a month, but after designing a home buying plan with us, we feel pretty comfortable around $4,500 a month, right? So that's a $2,000 uptick in my budget, but maybe I'm just lacking from a savings perspective. So what I would encourage our client to do is to implement a savings plan. And what that means is on the first of the month, when I'm paying my $2,500 rental payment, what I would want to do is also create the habit of paying $2,000 into my savings account, which would basically be the increase in my mortgage payment. So on the first of the month, when I'm paying that rent payment, while it might be a little bit tough, we want to take that, pay that $2,500 to my landlord, take another $2,000, automatically just deliver that to my savings account. And I know it's really simple, but that discipline of doing that on a monthly basis does a couple things. One is you see that savings account grow. So at the end of 6 months, maybe I'm at $12,000 in savings. Maybe at the end of the year, I'm at 24,000. So I've created that discipline of savings. More importantly, it gets me accustomed to really, or acclimated to paying a higher mortgage payment, right? We don't want to have that shock of, wow, I'm up $2,000 in housing expense. And so I think a savings plan like that can be really help support you on that path towards homeownership. Now, the challenge with savings is real. And so there's assistance programs available across the state of California. We're going to spotlight the CalHFA product. And CalHFA is the California Housing Finance Agency designed to support low to moderate income households. Now, we're proud to be the #1 provider of CalHFA programs in the state. You guys may have heard a little bit about CalHFA with the announcement of the Dream for All program. That's kind of been in the news quite a bit. I was fortunate enough to help develop the 1.0 version of Dream for All that we released last year. We're currently in the middle of funding the second wave of Dream for All. So that's kind of what's going on in the world. But on CalHFA, there's always some consistent products around in this product set. One of them is the MyHome Assistance Program, which provides up to 3% of your sales price in assistance for a conventional loan, 3.5% for an FHA loan. So it's really filling the gap for your minimum down payment for your home purchase. And so we're going to look at an example here in a second. But what that assistance does, it's creating a separate loan for you for 3% at a 1% simple interest rate loan, and no monthly payments are required. In fact, you don't even have to pay back that assistance until you either sell the home or if you decide to refinance in the future. Now, CalHFA also offers a closing cost assistance program. It's called ZIP. It's ultimately providing you 2 to 3% of your loan amount in additional interest-free assistance. The challenge with ZIP right now in today's elevated interest rate market, it doesn't necessarily make a lot of sense from a budget perspective because it can elevate the interest rate about a full 1%. So when we design home buying plans for clients, we generally will kind of focus just on the My Home Assistance Program right now. Now, with this program, there are income limits and you have to be a first-time buyer, which a first-time buyer is someone that hasn't owned a home in the last 3 years. And CalHFA has made qualifying very inclusive for this program because the income limits go up to 150% of the median income, which is a lot more flexible than we see with other programs. We've kind of spotlighted the income limits here for you for tonight's class. So if you're in Northern California, I know Ken can drop the Northern California or the total income limits in the chat there for you if you want to check that out. But CalHFA is a fantastic option. Now, I know I'm getting some questions in the chat and the Q&A, so I'm gonna tackle those. But let me just kind of give you a quick example of how CalHFA works. So we've talked a little bit about a sales price around $700,000, and so when we apply that to a standard conventional loan with a 3% down payment, and assuming closing costs of around 2 to 3% of my loan amount or my sales price, I should say, I would expect to probably save up about $35,000 to $42,000. Now that can be a bit of a stretch for most first-time buyers. But if I can implement something like the My Home Assistance Program and maybe fill the gap for that $21,000 down payment, now maybe I can only have to worry about paying closing costs out of pocket, maybe $14,000 to $21,000 or maybe less, depending on what's negotiated. But ultimately, that can make homeownership more of a short-term goal versus maybe a 3 to 6 year goal, right? And so that's kind of where My Home Assistance can help fit in for first-time buyers. Let me just take a quick question in the Q&A, and we're going to get back to some of the guidelines here. And one question was, what's the difference between a cash account and a checking account? And I should have probably kind of detailed this out a little bit. What I meant to say was cash that's being deposited into a checking account. So so we can't use unsourced deposits into a checking account. And then I was asked to kind of go a little bit deeper on, can you discuss more on 401k as a down payment? So what I'm talking about is borrowing against a 401k. So if I have a $50,000 balance on a 401k, maybe I can borrow up to half of the market value, so maybe $25,000. You can take that $25,000 and use it as assets towards your home purchase. Now, when you do a 401k loan, you're generally paying yourself back in interest, but you are taking money out of the market, so you could lose the appreciation if markets, change for you. So I would encourage you to talk to your financial or tax advisor before, dipping into those assets, but it can be used in home financing. All right. I think we're good. I think I saw a comment on audio breaking, but we'll double check that. I think we're okay on our side. Um, all right, cool. Awesome. Okay, I think we got that. Well, let's talk really quickly about borrower eligibility for the CalHFA program. For an FHA loan program, it does have a minimum credit score of 640, conventional loan at 680. The debt to income ratio can go 45 to 50%. One of the nice things about CalHFA is the income is based upon the applicant income, not the household size. So if I am going to buy in LA County and let's say I make 150,000, but my partner makes 100,000, well, 250 combined income exceeds the income limits. However, if I want to apply in just my name, then I could potentially get eligibility for the program. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So I may have owned back in 2020, sold that house, and now I'm ready to purchase again. Now I would still be considered a first-time buyer. And this is eligible for all one-unit properties, single-family homes, condos, townhouses, even manufactured homes. But manufactured homes are a little bit tricky because it has to be on land that is owned. You can't purchase like in a mobile home park where you lease the land. All right. All right. I was asked to clarify credit utilization, what that means. So let me just kind of to clarify that. And we also have that in the recorded version of tonight's class. But credit utilization basically is looking at your balances of your revolving accounts versus your credit limits for those accounts. So if I have a $10,000 credit limit and I have a $5,000 in balances, that means I'm at 50% utilization. So it's essentially a percentage of your total credit limits that are being utilized. All right. Thank you for the follow-up question. Appreciate that. All right, well, let's talk a little bit about the buying process. And we've created this 6 steps of home buying milestones to give you kind of a visual tool to really kind of see what does the path look like for home ownership and what am I going to experience as a buyer. Now, after leaving tonight's class, you're going to learn a little bit more about getting connected with me for a home buyer consultation. That's a 30-minute session that I do with all of our home buyers across the country to design a home buying plan for you, to talk more about what you've learned in tonight's class and figure out what a plan looks like for home ownership. It doesn't have to necessarily be a goal of achieving in 2024. It could be something in next year or the years beyond, but to kind of put a roadmap together for you. Now, the output of that session is going to be pre-approved. And that pre-approval essentially allows you to start your home search whenever that time comes. Now, a pre-approval essentially is like a certificate that gets presented to a seller that says, I'm eligible for my financing. I can present an offer on this property. It is usually good for 60 days, but we can recertify the pre-approval at any time. So you don't have to feel like there's a rush to go out and purchase a home. Now, step 2 is going to be the fun part. That's the house hunting. I know for most of us, it's going to start online. And then once we've identified a few properties that kind of fit our search criteria, then we would think about going out and physically touring those properties. I would encourage you to talk with a realtor locally in your community that can help support you in your home search, help negotiate, help kind of ordering inspections when that time comes. Now, I know there is changes in realtor commissions that just were implemented about 5 weeks ago with National Association of Realtors settlement that took place. Now, in that settlement, it does change the way in which realtors are compensated. So prior to that settlement, it was kind of always assumed that sellers were responsible for paying for realtor commissions. But now realtors have to negotiate commissions, not only with the buyer, as well as the seller of the home. When you kind of start working and partnering with a realtor, I'd encourage you to ask questions about that. I'm not an expert in that area by any stretch, but it's certainly a conversation to have with a realtor. Now, we do have preferred realtors that we work with all across the country. So when you decide to take those steps in homeownership, we do have additional resources for you. Now, let's kind of continue down the path. Let's say I start going out and looking at homes and I find a home I love, but then I want to submit an offer to that seller. Well, if that seller reviews my offer and the seller accepts my offer, now I have ratified a contract with the seller. And it moves us to step 3, and that's called entering escrow. And entering escrow means we've come together as buyer and seller. We're in agreement. And within 24 hours of the accepted offer, we're going to call you right away and say, hey, congratulations, because that's the first step. Now you have an accepted offer, and now we're going to set the stage for what timelines look like for you in your home buying process. So we're also going to schedule you for a follow-up video session that you're going to do with me to make sure that we kind of reaffirm all the numbers that we've talked about from our initial pre-approval conversation. What do interest rates look like today? What's the timeline that you should expect? What's our monthly payment look like? How much am I expected to put out of pocket? All those things that are really important for you in home ownership. Now, within 2 to 3 days of the accepted offer, you're responsible to deliver what we call is an earnest money deposit to the escrow company. That's usually 1 to 2% of our sales price. It's a good faith deposit that we make to escrow that basically shows that we have an investment in this transaction. Now, that deposit is protected by what we call as the contingency period. And the contingency allows us to do our investigative work on the property, which that includes getting the house inspected, which you're going to get maybe a roof inspection or a whole house inspection. We're going to get the house appraised as a lender to make sure the house is really worth what you're buying it for. And finally, we want to get the loan approved. And so your deposit is essentially protected within that time frame. The contingency period can be as short as 7 days. It can be as long as 21 days. It just depends on the terms and conditions of the contract. Now, as we move down kind of this workflow, step 4 is kind of more administrative tasks on the financing. We're doing processing of the loan. We're verifying your employment, verifying assets. We're probably going to have your interest rate either ready to be locked in or locked by that time. What happens in financing is based upon market conditions, we lock in interest rates. Now, there's a lot of strategy to that, especially in today's market where there's a really kind of a volatile situation with interest rates, depending on what economic reports are coming out. We consider ourselves kind of experts in managing through the market. So as we work through clients through the home process, we're going to try to strategically find the lowest possible time to lock in that interest rate. And then step 5 gets us about 3/4 of the way through the process. That's where our underwriter now has finished the review of your loan, issues the loan approval. It also brings us to the end of that contingency period. So if everything kind of checks out for you inspection-wise, loan approval, appraisal, then you're going to be okay signing off on your contingency for your home financing. That tells the seller that I've done all my due diligence and I feel good about moving to the final stages. It also brings us to the point in lending where we issue a final closing disclosure for you. It gives you a 3-day cooling off period before we get to the very final milestone. That's called closing the loan. Now, in the loan process, you get delivered different variations of disclosures. You get an initial disclosure within 72 hours of your contract. Once your offer is once your rate is locked in on your financing, you get another set of disclosures, and then you finally get that closing disclosure. Everything is very transparent and open. All those disclosures should align with each other throughout the process. At step 6, that's the one time you'll have to do an in-person signing. Everything in the disclosure process is always e-signature, but it's still kind of more of a old school process, if you will, at step 6, where we have to do in-person signings with a public notary. That process usually takes about 60 minutes, maybe an hour and a half, depending on the complexity of your financing. On that date, you'll also be responsible for delivering your final funds for closing on your home loan. We then reconcile all those funds along with the escrow company and then wire in funds for your financing and maybe an assistance program that you're electing. Once those funds are balanced, then the loan gets recorded with the county recorder's office. They record 2 deeds. One is a grant deed to transfer ownership to you, and then next is a deed of trust, which is your loan agreement on your financing terms. Once we get the confirmation of those things recorded, then this is the best call I get a chance to make in my day, which is to call and say, congratulations, you're now a new home buyer. And I get a chance to do that a couple times a day. It's the best part of my day because it's a huge deal, right? It's going to be one of the biggest investments and purchases you guys make in your upcoming financial futures. And obviously, you've taken time out of your busy schedules to join us in a class on a busy Wednesday night. So clearly, you see the importance of that. But truly, it's a huge celebration at the end of the process. And we always congratulate all of our clients and celebrate with housewarming gifts and all that stuff because, like I said, it's a big deal. Now, if you're thinking about getting on the path towards homeownership after tonight's class and you've kind of sparked a little bit of interest out of tonight's class, I'd love to be able to chance to meet with you for a one-on-one video session with you. And it's a really simple get started process. We only have an online application that we do. We have a soft credit check so your score isn't impacted. Then you have to upload some documents, and then we meet with you for a 30-minute video session. And like I said earlier, it's not necessarily a goal for maybe this year for you. It doesn't have to be a goal for even next year. It's just to help provide you with more of a roadmap with goals and objectives for homeownership. If you have some questions after tonight's class, we want to get connected with you as well. So you can set up an introductory call. We'll spend 10 to 15 minutes answering questions for you, maybe explaining the process a little bit better, maybe doing a little bit of a repeat of what we discussed in tonight's class. Well, you'll see in the presentation that goes out to you tomorrow, you have all the links here to schedule one of those sessions. whatever works best with you. But with your consultations, everyone that attends our classes is going to be meeting with me one-on-one to design that plan. And here's kind of what the consultation looks like. We're taking a look at where do I want to buy? What's my budget look like? Is there any areas of opportunity for credit? I really want to help you understand what assistance resources are available to you, and certainly understand the buying process. But that session should be about 30 minutes to discover all those things and ultimately walk away with a really clear understanding of what your plan looks like. Now, we have some really great resources that are available to you. We do a lot via mobile. We try to really embrace technology at APM. While we have technology resources, it doesn't replace kind of the human touch of this process, because it is a big deal for you guys. We have a very systematic communication process. You're interacting with us via text, via phone, via email, just to make sure that everything is always up to date in the communication that you're receiving. And as we wrap up tonight's class, I just again want to thank you for being part of this class. And we're really excited about our Long Beach State Alumni and Athletics partnership. We're going on like year 3 here, and really successful partnership. We got a chance to come out to events every once in a while. But we also provide a discount for you in being part of this partnership. Not only do we provide our resources and classes, but we discount our services. And if you've enjoyed tonight's class, we'd encourage you to share all this information with friends, family, coworkers. We still have classes still on the calendar left for 2024. So if you'd like to have them attend one of our live classes, they can visit mortgageeducate.com. We have all of our classes for the remaining schedule of the year, all available. They can sign up at any time. And all of our information that we share in our classes is up on our YouTube channel. Like I said, we're recording tonight's class. We'll have that up there tomorrow. And we have a lot of good information we're putting on our socials like Instagram. We try to put, content that's going to help you, and also celebrate home ownership. In fact, just today, we hosted one of our newest homeowners, Sok Young, here in the Sacramento market, really getting a chance to celebrate his accomplishment in home ownership. So with that being said, I really appreciate everyone joining tonight's class. We're going to open it up for some questions. I know we're almost to the top of the hour. Got a couple minutes, but I want to stay here to answer any questions. I know we've kind of weaving in some questions already, but what can I help answer from tonight's class that we haven't covered so far? And of course, if you have any questions, you can drop them in the chat or the Q&A. Got the Go Beach in the chat. I like that. Very cool. I got my Long Beach State on. If you guys can see, I got my shirt on. I was trying to get the rock the beach gear here tonight. All right. I think we're good, unless you guys have some questions. I don't see anybody drop anything in the chat or Q&A. Thank you again for spending your Wednesday evening with us. I hope I get a chance to get connected with each of you to help you on your path towards homeownership. Love to be able to be kind of a partner in that journey. And we will look forward to talking to you soon, and we'll get the presentation material out to you tomorrow morning. Have a great night. Talk to you soon.